If you don't understand liquidity, you don't understand trading. It's that simple. Most traders, especially when they're starting out, believe price moves because of indicators crossing over, or some big news event, or maybe a fancy chart pattern they just learned. But the real, fundamental truth is much simpler than all of that. Price moves for one primary reason, because liquidity is being taken. That's the engine of the market. It's the fuel that makes price go from point A to point B, and once you see it, you can't unsee it. In TSBTO, I'm going to pull back the curtain and show you what liquidity really is. We're not just talking theory here. We're going to dive deep into where it actually lives on your chart, and most importantly, how the big players, the institutions, the smart moon. This concept to engineer price moves that often leave retail traders on the wrong side of the market. By the end of this, you'll look at your charts in a completely new light. So, stick around, because this concept is a complete game changer. Let's start with the most basic question. What exactly is liquidity? In the simplest terms, liquidity is just a pool of orders resting in the market. Think of it like a big, invisible collection of intentions waiting to be triggered. These orders aren't active trades just yet. They're sitting there, waiting for price to reach a certain level. What kind of orders are we talking about? Well, it's primarily three types. First, and most importantly, you have stop losses. Every trader who enters a position has a stop loss somewhere to protect their capital if the trade goes against them. A stop loss on a buy position is a sell order, and a stop on a sell position is a buy order. Second, you have pending orders. These are things like buy stops and sell stops, or buy limits and sell limits. For example, a trader might place a buy stop order above a key resistance level, thinking, if price breaks out above this point, I want to get in on the move. That buy stop order is just sitting there, adding to the pool of liquidity above that resistance. And third, you have the breakout entries themselves. This is very similar to pending orders, but it also includes traders who are manually watching the chart and waiting to click the buy or sell button the second price breaks a significant level. All of these stop losses, pending orders, and breakout entries are clustered together at obvious price points on the chart, creating these dense pockets of liquidity. Now, why is this so important? It all comes down to the size of the players. A retail trader like you or me, we're trading relatively small size. If I want to buy one lot of a currency pair, I can click the button, and my order gets filled instantly. The market can easily absorb my small order without any issue. But what about an institution, a hedge fund? A major bank there not trading one lot. They're trading thousands of lots. They're looking to move hundreds of millions, or even billions, of dollars. Think about it. If a giant fund wants to buy a massive position, they can't just smash the market by button. If they did, there wouldn't be enough sellers at the current price to fill their entire order. Their huge demand would instantly drive the price sky high against them, giving them a terrible entry price. This is called slippage, and it's a huge problem for them. So, what's the solution? They need to be smarter. They can't just enter whenever they want. They need to find a place where there are enough opposing orders already waiting in the market to absorb their massive size. In other words, they need liquidity. They need to go where the stop losses and breakout orders are. This brings us to the core concept: why price actively seeks out liquidity. This is a fundamental shift in perspective. Most traders think they are chasing price. They see price moving up aggressively and they think, oh, I've got to jump in. I'm missing out. But the institutions aren't chasing price. They're the ones moving price with a specific purpose: to go to a location on the chart where liquidity already exists. They are the hunters, and the pools of orders are their target. So, when you see a very sharp, aggressive move on your chart, your first thought shouldn't be, wow, this is the start of a huge trend. More often than not, that aggressive move is actually the process of the big players collecting orders. Let's say a fund wants to sell a huge position, but to sell, they need buyers. Where are the buyers? They're sitting right above recent highs in the form of buy stops from people who are short, and breakout buy orders from people waiting to go long. So, what does the fund do? They will engineer price to push up aggressively into that area above the highs. This does two things for them. First, it triggers all the stop losses from the sellers, which are buy orders. Second, it tricks breakout traders into thinking the price is rocketing higher, so they jump in and buy. Suddenly, there is a massive flood of buying in that specific area. And right into that wave of buying, the institution can quietly unload their massive sell position, getting it filled without causing the price to crash against them. They are selling to all the eager buyers. Once they've collected enough orders and their large position is filled, there's no more reason for price to be up there. The buying pressure that was engineered to get there evaporates, and now price is free to move in the true, intended direction, which in this case is down. The traders who just bought the breakout are now trapped, and their stop losses below the low become the next target. It's a cycle. Price moves from one pool of liquidity to the next. So where do we actually find these magical pools of liquidity on our charts? The good news is they're not hidden in some secret location. They are found in the most obvious places, precisely because that's where the majority of traders are taught to place their orders. It's predictable human behavior. The first and most common place is above equal highs and below equal lows. When you see price hit a level twice and fail to break through, forming a double top or a double bottom, what do you think is happening right above those highs or right below those lows? It's a massive collection of stop losses and breakout orders. These clean highs and lows are like a magnet for price. Next up, we have trend line. How many traders learn to draw a trend line and place their stop just on the other side of it? Millions. So, every time price comes down to touch a rising trend line, a pool of sell stops accumulates just beneath it. Smart money knows this, and they see that trend line not as support, but as a future target. Another key area is the previous day's high and low. These are significant reference points for many traders and algorithms. A huge number of orders will be placed around these levels, making them prime targets for liquidity grabs, often right around the opening of a major session like London or New York. Finally, you have the extremes of a trading range. When price is consolidating sideways in a box, everyone can see the clear support and resistance levels. Where do you think the stops are? Just above the top of the range and just below the bottom. Price will often spike out of one side of the range, grab all that liquidity, and then reverse sharply back into the range, heading for the liquidity on the opposite side. If you learn to spot these obvious areas, you're starting to see the market map that institutions use. Now that we know where liquidity lives, let's talk about the specific price action pattern that shows us it's being taken. This is called a liquidity sweep, sometimes known as a stop hunt or a Judas swing. A liquidity sweep is exactly what it sounds like. Price makes it fast. Aggressive move into one of those key liquidity areas we just talked about, like above an old high, takes out all the stops and entices breakout traders, and then almost immediately reverses direction with equal or greater force. The key characteristic is the sharp rejection. The move into the liquidity zone looks incredibly strong. The candle might be a big, powerful one. It screams strength, but it's a lie. It's manufactured strength designed to trap traders. The real move is the reversal that follows. When you see price spike above a clear high, only to slam back down below it within the next few candles, that wasn't a real breakout. That was a liquidity sweep. That wasn't a sign of bullish strength. It was the institutional footprint of them filling their sell orders before marking the price down. Recognizing this pattern is crucial. It stops you from being the trader who buys the top or sells the bottom, and instead allows you to align yourself with the real institutional move.